There's a ton of support down here at this 30 or just sub 30,000 level. That for me would be a quick trading opportunity. So I'm a trader by nature. So if we flush down there, I would probably buy it for a quick bounce and then exit. But ultimately, my fear again is that if we do see that flush out, once you take out the 30 to 20, pretty crazy period right now. Very, very messy in terms of so many different things intertwining, whether it's the war with Russia invading Ukraine, or it's the Federal Reserve, which is now talking about 50 basis point rate hikes continually throughout the course of the year, or an economy that is coming out of COVID and right now is doing all right. But my guess is it won't last very long with hikes in interest rates. So I think for investors, the key is to be nimble, right? You can't, it's not the buy and hold environment that it was over the last 10 years or more, where the Fed was always pumping liquidity into the system and it was always backstopping the market. Now inflation for the first time in 20 years is well above the 2% range at almost 10%. And you have to understand that that's the greater evil right now for the Federal Reserve. So before it was a slow economy, people unemployed because inflation was sub 2%. Now with 8-10% inflation, the Fed needs to attack that. That means they're going to go on the defensive and really probably hurt valuations in stocks and even cryptocurrencies to some extent because of the tightening. And I'm glad you're clarifying that because, to me, it's all about what the charts are saying. So when the charts are giving me probabilities that we're still headed lower in the near term, that's the way I'm gonna call it. I just have to call it like it is. There's so many people out there in social media that just go out and say these ridiculous things with no backing. But for me, there's actually a lot of chart work and cycle work that goes into it. So if you look at the chart, and we'll show this in a little bit, but you basically have a bear flag forming since January, which is classic. You can look it up in any textbook on technical analysis, and it tells you that you will likely, the probabilities again, which aren't 100%, but it's giving you the odds favored that you will be headed lower in Bitcoin. And again, if you look at past cycles, right, we've always seen an 80 to 85% decline in a bear market. A lot of people would argue this isn't yet. I think it is because it matches up with the 4-year cycle of Bitcoin. And there's not enough crypto investors talking about this. I mean, if you're going to see the stock market decline and the Fed continue to tighten and pull money out of the system, that is inevitably going to affect crypto in the near term. And then you go back to situations like what we saw in 99, 2000, where you had the .com blow up. And Amazon, one of the greatest companies in the world, went from $112 at the time to $6. And so if you just map that out to what Bitcoin could do, it is enormous in terms of the potential downside. So yes, I'm still on the bandwagon for 20,000 as a target, or even lower, to be honest, if we really do see a washout. But the longer term view, and this is the part that gets lost in translation, is the longer term is Amazon went from $6 to 3,800, right? Bitcoin, it's changing the world. Crypto is changing the world. It will be the digital gold. It will be adopted by more and more countries like El Salvador. The metrics are there where it will have a similar type move. And if you think about $6 to 3,800, what would that, even if Bitcoin went to 5,000, think about what price target that puts on Bitcoin longer term. Now, again, for me, that's kind of a 5 to 10 year outlook where we get to that price. But again, near term, I am bearish. I do think you'll get a better investment opportunity if you wait patiently to buy Bitcoin. An investor, we always have to look for different, thought processes and different thought theses. And I think that's definitely one way to look at it. The only thing I would push back on that with is that the things that have happened over the last year in crypto are very reminiscent. So for instance, the chart pattern in 2021 with an M top on Bitcoin is identical to the Amazon chart in 99 to 2000 before it went and had that drop to about $6. In addition, there's some weird things like the crypto market hit, I think, a valuation of 3.1 trillion last November. At the height of the .com bubble, the .com stocks were 2.9 trillion, almost identical. And then one of the weirdest ones is, here in the US, the Super Bowl is like the biggest sporting event. In 2000, just before the .com collapse, the Super Bowl had more .com commercials than really anything else. It was immense how much the commercials were about the .coms. A lot of those companies ended up going out of business. And then you had this last Super Bowl here in the US where it was kind of the crypto Super Bowl. You had so many crypto commercials. Everything was crypto related to the Super Bowl. So these similarities are so kind of crazy. In addition, I mean, if you think about it, like you're hearing more and more this game-changing technology. And granted, you might have heard that back in 2017. But for me, it's like what I can't get over and what makes me so worried about the crypto space in the near term, even though long term I think it will survive and thrive, is that you have so many coins out there. Why is there a need for 18,000 cryptocurrencies, and how can that many survive? And don't you need a flush out to kind of get rid of 90% of them so that you can have the best 10% survive and thrive? And that would be my kind of one thing, is that it's hard to imagine we've seen that flush out when there's so much junk in the system. Dogecoin, I mean, Shiba Inu, I mean, those are just joke ones that have billion-dollar, multi-billion-dollar valuations. But if you go down that list, I mean, it's endless. I think there's more cryptos than stocks out there at this point.
My next big buy would be when Bitcoin would hit $30,000. And I just think if Bitcoin's destined for 100,000, 500,000, a million over the next decade, then the difference between buying at 30,000 or 20,000 really isn't that much of a difference. Yep. So my question to you is, what if you're wrong? What if Bitcoin never gets to $20,000 and you potentially miss out on one of the biggest bull runs in history?
Mm. So that's a great question, and you're right on that, is you always want to be prepared for the unexpected. So if you expect one side and you get the other, you need to be able to maneuver. So based on my chart analysis, is right now we're forming this bearish pattern. If for some reason you break above that bearish pattern, then that changes my thesis in the near term. So again, my bearish pattern, and I can show it in just a minute, but basically it's around that 50,000 level. So if we get back above 50 and we stay there for a few days, then all of a sudden you've broken that bear flag pattern, and that gives me the bull thesis that's, okay, this is not necessarily that bear flag that's going to play out to 20,000 or even sub 20,000. So you always want to be flexible. It doesn't matter if you're a bull or a bear. The best bulls and bears out there are going to be ones that can shift. They can change their look on really the drop of a hat so that they can maneuver and still make money. If the chart ever tells me something else, I'm all about switching that and moving into it. In addition, one of the things I would say to people is if you're, like you said, and you said this great, is that, you know, if you're someone like me who believes 50,000, then 100,000, then 500,000, maybe a million, then you're right. There's nothing wrong with having a position in Bitcoin now, because it's negligible if it goes even down to 20,000 from this level. What I would suggest is have a plan where if that does happen, dollar cost average. So at least you accumulate and you drop your average down. So, you know, what I do is generally like what I'll probably do is start buying just above 20,000, because everyone's talking 20,000. So sometimes that never gets hit. So maybe at 21, I'll put 5% of my portfolio, my long-term crypto portfolio in Bitcoin. Then if it goes to 17, I'll put another 5%, at 14, another, and kind of build it that way. And so you can do that. You could even start doing that here, and then at 20, at 35, at 30, at 25, and all the way down, and just dollar cost average. Because ultimately, I think we all agree, crypto's here to stay. It's here to change the way the world works. And it's going to be much, much higher over the next 5 or 10 years. Bonds you do want to pay attention to, because the bond market and interest rates are the main thing that I focus on. And obviously the interest rate on the bond is why you pay attention to the bond market. And what you can see here is this was a trend line that I had on my chart that goes all the way back to 1987, which is kind of interesting because that was the 1987 crash in the stock market, kind of the last time we saw a crash. And what you could see here is this trend line has just been broken. Now, I do have resistance at 3% here. There's a pivot point going back to 2018, which was right up in that level as well. So I think we're probably due for a small pullback in yields. But I would say that based on this chart, if this is a true breakout, then the yield is going to go quite a bit higher. And again, the question is, how high can the Fed let the yield get before it influences the economy in a very negative way? And it's one of the reasons why I'm a little bearish for late 2022 on the economy and early 2023, because rising interest rates historically hurt the economy. All right, it makes people pull back on spending, it makes people pull back on purchases, and therefore it slows the economy. So certainly you want to pay attention to the yield curve, and we know inversion has occurred, which is also a recession indicator. And right now you have a breakout. I think you have a little bit of a pullback coming in the very next couple of weeks, and then I think you're probably headed north of 3%. S&P today is having a good day, but one of the things that I'm starting to pick up on. So let's go pre the start of 2022, right? So here's where 2022 began, right in here. And what you could see here is going into 2022, we were always making higher highs, all right? All higher highs, right? And higher lows. And that's generally telling you that the trend is strong and it's bullish. Now, what we've seen is as soon as the Fed started to talk about raising interest rates, the economy, or at least the stock market, started to make lower highs and lower lows. So that is something that I'm paying attention to. I think the other facet that we have to remember is that in terms of the market, all right, so this is now zooming out on the S&P. This was your long-term trend during the last 10 years, right? From 2011, 2012, all the way here was your COVID dip. March of 2020, that massive sell-off. And you could see how the market stayed within this range. Now, we saw this massive move up in the stock market because extraordinary financial measures were taken when COVID hit. The Fed printed more money than ever. The government sent checks here in the United States to people just to get them to spend and get them to stimulate the economy and to help out with paying bills. And that created this massive surge up in the stock market. The Fed is removing that excess liquidity. And so it makes a lot of sense that we would at least go back inside of this longer term trend where we were prior to where the Fed went nuts on stimulating the economy. Now, this area here doesn't even insinuate a recession, but I think in the very least later this year, even before a recession hits, we're likely back in this range. And honestly, this is about 25% lower, maybe a little less, maybe 20 to 25% lower than current levels on the S&P. So there's a lot of downside just to take away the crazy liquidity that the Fed and the government injected in the last couple years. So for me, I would expect this upper range to be hit by later this year. And then I do think that once the market, so this is the scariest of all scenarios where you have inflation remaining high, right? So the idea of raising interest rates is it sucks liquidity out of the system and it'll push inflation back down, or it'll bring inflation back down. My fear is inflation is going to come down, which is positive, but I don't think it's going to go back to 2%. I think we're going to be stuck at this longer term 5-6% inflation. And then the scary thing is, if you have a recession during a high inflation period of even 5 or 6% per year, what that's known as is stagflation. And stagflation is the worst of all because it basically means people are losing their jobs or not making more money. And they have to pay more, they have to pay higher prices in terms of food, energy, rent, and all these other things that are going up. And that means there's a deficit, right? Usually during inflationary times, it comes during market expansions, economic expansions, where, you're making an extra 5% on your income every year, you're getting raises, you're getting bonuses, but prices are going up. But at least you can handle that because the prices are going up while your wages are going up. Stagflation is the worst, and I do fear that will start to be talked about more and more later this year. So the key is to drawing a proper trend line is you want it to intersect as many points as possible that make sense. So what I would say is, basically at the very tops, it would just intersect the very tops. So you're almost perfect. In fact, it's in terms of charting, you're fine on this. And same thing with the lower one. It looks very, very good.
Yeah, so obviously I can see that this 30,000 mark is a really strong point here. And this is the 20,000 dreaded mark that a lot of investors don't want to see. Okay, good to know that I'm on the right track with my TA, but no, feel free to take it back.
Is that bearish pattern. And the beauty of, again, this is that as a trader or as an investor who follows charts, we have to have the ability to adjust our views, right? So for instance, what I was saying before, if Bitcoin starts trading up here outside of this bearish flag, well, then that changes my thesis. And I think that's important. So again, a trader, you never want to be so in love with a stock or a crypto where you can't see the different changing, cycles. And I think that's important for us to all hear. So if we start trading up here, then honestly, I think you do go, there's a decent chance we at least go back to the 68, 69,000 level up here. Now, as of now, that's not what the chart is telling me, so I have to go with the bearish case until proven otherwise. But yeah, certainly I'm looking at the same thing there's a ton of support down here at this 30 or just sub 30,000 level. That for me would be a quick trading opportunity. So I'm a trader by nature. So if we flush down there, I would probably buy it for a quick bounce and then exit. But ultimately my fear again is that if we do see that flush out, once you take out the 30 to 28,000 level, there's not a whole lot of big support, as you can see here, until you get down to really right here, which also is the 20,000 level. But if you go back to 2017, it's also that high pivot. So if I zoom out here, we can see that line right there. So again, you know, it's I think for people that have longer term views, it's somewhat inconsequential. I would just consider advising to dollar cost average if it does dip. But if you're someone like me who's a little shorter term and I have the flag patterns and the probabilities are telling me something, and I've done this for 20 years, then for me, I'll look for those lower entry points and then kind of trade around the position. So when you see this pattern, and this pattern occurs and repeats in so many charts, if you looked at this pattern in 1,000 charts, I would say 75% of them would have a down move. So that's kind of where I look at it. Like I always say to my members is where we want to be the house of the casino. We want to be the casino. We don't want to be the gambler. The gambler 50-50 or just sub 50-50 odds. I want to be someone who, yes, I'll lose sometimes. Sometimes a gambler comes into my house and takes me for some money. But if you have 1,000 gamblers coming in there, in general, the casino is always going to make money. And that's how I look at my trading and why I use the charts and probabilities.